Hello everyone, I'm Justin Bender, Portfolio Manager at PWL Capital in Toronto, and creator of the Canadian Portfolio Manager blog. In the last installment of my Understanding ETF series, we toured the U.S. equity ETF landscape, covering solutions you can use to diversify your portfolio's domestic stock allocation. Of course, when it comes to investing, you don't need to limit yourself to North America. Today, let's head overseas to explore how to further diversify your global portfolio by adding ETFs from other developed markets around the globe. Before we get going, when I refer to international investing in this piece, I'm talking about investing in developed stock markets outside of North America. Since it would get pretty tedious if we use that entire phrase every time, this is the common shorthand for them in Canadian financial speak. We'll roll with that. In 2001, BlackRock released the iShares MSCI EFI ETF, EFA. MSCI is an acronym for Morgan Stanley Capital International, while EFI stands for Europe, Australasia, and the Far East. EFA tracks the performance of over 900 large and mid-sized companies located in 21 developed countries around the world, excluding Canada and the US. EFA's largest holdings include a number of familiar names most Canadians will instantly recognize. As EFA trades in US dollars on the US Stock Exchange, Canadian investors may find it more convenient to purchase the BMO MSCI EFI Index ETF ZEA instead. ZEA follows the same index but trades in Canadian dollars on the Canadian Stock Exchange. Each company in the MSCI EFI Index is weighted according to its float-adjusted market cap. For more information on float-adjusted market caps, please watch my video Understanding Canadian Equity ETFs. In 2007, BlackRock also launched the iShares MSCI EFI Small Cap ETF, SCZ. SCZ complements EFA by following the MSCI EFI Small Cap Index, which tracks the performance of over 2,300 smaller companies located outside of North America. By allocating about 85% of your international investment dollars to EFA and the remaining 15% to SCZ, you gain float-adjusted market cap exposure to most developed stocks outside of North America at an annual MER of about 0.33%. True to form for our clever index providers, there's also a single index that combines the MSCI EFI Index and the MSCI EFI Small Cap Index. It's called the MSCI EFI IMI Index. IMI stands for Investable Market Index, which includes large, mid-size, and small-size companies. This index follows the performance of over 3,200 international companies, providing broad stock market exposure. You may now be thinking, I'll bet there are ETFs available to invest in those MSCI EFI IMI index companies. That way, I can invest in one fund instead of two and achieve the same goal. If you leap to this conclusion ahead of me, congratulations. You're not only correct, you're clearly getting into the swing of my Understanding ETF series. For starters, the iShares Core MSCI EFI ETF, IEFA, trades on the US Stock Exchange in US dollars. IEFA tracks over 3,200 international stocks and has a cost of about 0.08% per year. In addition, its sister ETF, the iShares Core MSCI EFI IMI Index ETF, XEF, trades on the Canadian Stock Exchange in Canadian dollars. XEF also tracks over 3,200 international stocks and has a cost of 0.22% per year. IEFA is generally less tax efficient than XEF when held in a TFSA, RESP, RDSP, or taxable account. That's due to the extra 15% U.S. withholding taxes that apply on foreign dividends paid to Canadian investors from this U.S. fund. XEF, on the other hand, holds most of its underlying stocks directly in a Canadian domiciled fund structure, so it avoids this second layer of U.S. foreign withholding taxes. For more information on foreign withholding taxes, please refer to our white paper on the subject, but here's a quick view of their expected impact. In 2015, Vanguard Canada released the Vanguard FTSE Developed All-Cap ex-North America Index ETF, VIU, to compete with the tax efficiency of XEF. VIU follows the FTSE Developed All-Cap ex-North America Index, which tracks the performance of over 3,600 companies located in 23 developed countries outside of North America, making it similar to IEFA and XEF. As discussed in earlier installments, FTSE stands for Financial Times Stock Exchange, and All-Cap indicates that the index tracks large, mid-cap, and small-cap companies. Vanguard's VIU fund has an MER of 0.23% and holds most of the underlying stocks directly in a Canadian domiciled fund structure. This structure makes VIU similar to XEF in terms of tax efficiency. The biggest difference between the FTSE Developed All-Cap ex-North America Index and the MSCI EFI IMI Index is that FTSE considers Korea to be a developed country, while MSCI classifies it as an emerging market. This means that VIU, which follows the FTSE Index, tracks more than 400 additional Korean companies than XEF, which follows the MSCI Index. FTSE and MSCI's market classification of Korea accounts for the large difference in the number of companies each index tracks. In fact, VIU currently allocates approximately 5% of its holding to Korean stocks, while in turn underweighting many of its other top country holdings. Since 2003, the FTSE Developed All-Cap ex-North America Index has returned 6.6% in Canadian dollars on an annualized basis, while the MSCI EAFE IMI index returned 6.1%. The difference in returns can largely be attributed to the exclusion of Korean stocks in the MSCI EAFE IMI index. Over the same time period, Korean stocks returned 8.8%, which was higher than the returns of all the international countries with larger market caps. If you prefer XEF to VIU, but want to ensure that the portfolio includes Korean stocks within your emerging markets allocation, please subscribe and tune into our next video, Understanding Emerging Markets Equity ETFs, to learn more.